Good morning. I'm Suzanne St. Pierre, and I'm the chair of Venable's New York Real Estate Department. And we're delighted to welcome you here this morning. Today we're going to talk about opportunity zones, and I think it's fair to say that this is the hottest topic in real estate today and widely viewed as a potential market disruptor. But while investors are scrambling to identify opportunity zone investments, there are many requirements that need to be satisfied to comply with the OZ program, and there's a lot about the OZ program that is not yet known. Venable has a very robust tax credit finance and syndication practice and has been advising clients in connection with opportunity zone investments. Our co-presenters today from Morgan Stanley are also deeply involved in structuring and advising clients seeking to acquire opportunity zone investments. And I think together we are going to have some interesting legal and business perspectives on the program today. I'm going to start with a couple of announcements first, and then I'll introduce our panelists. First, for the attorneys in the room, this program is eligible for 1.5 CLE credits, and you can obtain those credits by signing in at the registration table if you haven't done so already. This program is being recorded, and there may be members of the press in the audience, so please be advised. We also wanted to mention that forming a fund, of course, involves compliance with securities laws, and an OZ fund, like any other fund, entails a lot of securities law compliance. But that's not going to really be the focus of our discussion today. We're really not going to talk about securities laws at all, but we just wanted to note that that is an important part of structuring an OZ fund. We've also decided that we're going to go through the program, straight through the program today. So if you have questions, please note them, and we'll have time at the end for a Q&A. So let me start by introducing our panelists. We have Walter Calvert, who is a partner in Venable's Tax and Wealth Management Group. Walter's practice focuses on public finance, project finance, federal, state, and local taxation, and exempt organizations. He has extensive experience with tax-exempt debt issuance, tax increment financing, new markets tax credits, and affordable housing. Michael Bloom is counsel in Venable's Tax and Wealth Planning Group, and Mike provides advice on all types of corporate transactions, with a focus on advising emerging fund managers on fund formation and portfolio acquisition. Liz Steef is an associate in Venable's Tax and Wealth Planning Group, and Liz's practice focuses on corporate advisory work, including acquisitions, mergers, and joint ventures, and tax controversy work. Erin Berry is the Executive Director of Alternative Investment Product Origination and Development at Morgan Stanley Smith Barney. Erin serves as the head of project origination and development for real estate, fund of funds, exchange funds, managed futures, and custom offerings for Morgan Stanley Alternative Investments. And Mihir Patel is the managing member of the PKB Insight Group at Morgan Stanley. The PKB Insight Group is a team of financial advisors, client service associates, and certified financial planners that provide investment solutions to ultra-high net worth families and individuals, small to medium-sized institutions, private equity firms, and hedge funds. Here's an outline of today's discussion. Liz and Mike are going to start with a discussion of the legal requirements governing opportunity zone investments. Then Mihir will provide some insights on trends in private wealth investment strategies in the market today, including opportunity zones. That will be followed by a discussion by Walter and Mike on the legal aspects and challenges of OZ fund formation. And then finally, Erin will discuss some of the Opportunity Zone products on the market and how Morgan Stanley differentiates and evaluates them. And then we'll take questions. And with that, I'm going to ask Liz to please take it away.
Sure, thank you. So as I'm sure we're all aware, this new Opportunity Zone program is part of the Tax Cuts and Jobs Act of 2017. It wasn't one of the things that got a ton of coverage at the time the law was enacted, but since then it's really picked up a lot of steam, especially starting in the second half of last year. The aim of the program is to encourage economic growth and investment in designated low-income communities by providing certain federal income tax benefits to people who invest in businesses in those communities. The way the communities were selected is that all of the states nominated certain census tracts that would be eligible for the program, and then these tracts were approved or not approved by the government. At this point, all of the census tracts have been approved. One thing that's, I think, interesting to note about this is that you can have some census tracts that are designated low-income communities in surprising places. We usually tend to think of it as more urban, distressed areas, but these can be also highly commercial areas that maybe don't have a lot of residents, and the residents that live there have a low income, so areas that are close to airports, heavily commercial areas, and also rural areas. There are a number of rural census tracts that also qualify for the program.
Liz, to your point about some surprising areas designated as opportunity zones, if you look at the map at Manhattan, for example, you can see on the right side, a lot of the Lower East Side designated an opportunity zone funds. That's partly because of the test for qualification. It's an income test based on the residents that live there, and maybe those residents fall in the lower quartile based on how the tests work, but they're very desirable areas from a development standpoint based on new bars, restaurants, hotels going into those areas. So you can get sort of that disconnect between developers already interested in investing in some of these areas, but also having been designated an opportunity zone.
And this similarly shows the map of Brooklyn. And if it's a non-Manhattan or Brooklyn project that you're interested in, it's very easy to go online and see if you're in a census tract that qualifies. So what is the Opportunity Zone program? Well, first, who is eligible? Any taxpayer who recognizes capital gain from the sale or exchange of property after December 31st, 2017. There's two big points to remember about this. In order to be eligible for the program, you have to have gain to roll over. So you have to have an asset that you sell and have gain, and you roll over the gain into a fund. If you just are sitting on cash, you don't qualify for any of the tax benefits that we're going to talk about. The other thing to mention is that you only have to roll over the gain. So if you buy a share of stock for $100, you sell your stock for $110, you don't have to roll over the $110. You only have to roll over the $10 of gain to qualify. How do you participate? You take your $10 in our example and you invest that amount in a qualified Opportunity Zone fund within 180 days from the date that you sold your share of stock or your other capital asset. There's a special rule for partnerships that's really beneficial. If you're an investor in a partnership and the partnership owns a capital asset, let's say the partnership sells this capital asset on January 1st and the partnership decides it does not want to roll over. Typically, the partnership would have until June 30th of that year to make its qualifying investment, 180 days from January 1st, the date of the sale. If the gain is at the partnership level, though, and the partnership decides not to roll over, the partnership can pass the gain out to its partners, and the partners can make their own individual election. Because the partner won't know until the end of the partnership's year whether the partnership is going to roll over, the partners will have until 180 days after the end of the partnership's taxable year to actually roll over their gain. So if you think about a taxable year partnership that sells an asset on January 1st and doesn't roll over, the partners will have until June 30th of the subsequent year to actually roll over. So it's huge. It really extends the period of time that you can look for an investment and actually structure your investment. Why does someone want to participate? Well, we will go through the tax benefits. There are three main tax benefits that are part of the Opportunity Zone program. The first one is gain deferral. So in our example, we bought a share of stock for $100, we sold it for $110, we roll over our $10, we had gain of $10. Typically, you would write that on your tax return and you would pay tax on it in the year of the sale. The first benefit for the Opportunity Zone program is that you don't have to pay tax on that $10 of gain until the earlier of when you sell your investment in the fund, or December 31st, 2026. So one thing that's really important and that some people kind of are forgetting about is that if you are rolling over gain, as we'll talk about later, there's benefits to holding your investment for a long period of time. Even if you're still holding on to your Opportunity Zone Fund investment in 2026, you need to recognize the gain that you rolled over, so you're going to have tax in 2026, regardless of how long you hold your investment. So you need to plan for the fact that in 2026, you may still be holding on to this fund investment for other tax benefits, so you're going to have a tax event without any cash. The second tax benefit is that if you do hold your investment for a certain period of time, you can exclude some of that gain that you initially rolled over. So in our very simple example, we had $10 of gain that we rolled over. We didn't pay any tax on this gain when we sold our asset, and now we've held our interest in an Opportunity Zone Fund for at least 5 years before we hit this 2026 time limit when we have to actually pay the tax. So in our initial example, we would have had $10 of gain and we would have paid tax on that. If you hold your interest in the fund for 5 years before 2026, you get to exclude 10% of the gain. So instead of $10 of gain, you have $9 of gain. You never pay tax on that $1. If you hold it for 7 years before December 2026, you get a 15% exclusion. So instead of $10 of gain, you have $8.50 of gain. You never pay tax on that $150. The third benefit, which is the biggest benefit and the one that's getting the most coverage, is that you don't have any gain on future appreciation in the fund. So like we talked about, that $10 that you rolled over at 2026, you're either going to have to pay tax on $10, $9, or $8.50, depending on how long you've held your investment. But any gain that comes up above that $10 that you've invested, if you hold your interest in the Opportunity Zone Fund for at least 10 years, you don't have to pay any tax on that future appreciation. This includes the net investment income tax, or the Medicare tax, the 3.8% tax. And one thing to note is that this includes all of your gain from the investment. So you have to hold it for 10 years, but you don't have to sell in year 10. So you can hold it for 15 years, and you get to exclude all the gain from the 15 years of appreciation, not just 10 years. So you don't mark to market after 10 years, and then the next 5 years of gain is taxable. It's that whole period. So you could hold for 20 years. There is a little bit of a time limit to this. Under the proposed regulations, you have to sell your property by 2047. So this lets you hold an investment for 20 years. Basically, you have to invest by June 2027. I'm sorry, I think I said 2027. You have to sell by 2047. The way it works is that if you invest by 2027, you would hold for 10 years, and then you'd have an extra 10 years to dispose of the asset. You need to dispose of the asset by the end of 2047 under the proposed regulations. But I will say there have been comments on adjusting that sunset provision.
I have one point on the second bullet is particularly important. The way this rule works is that if you hold for 10 years and then you sell after 10 years, assuming the other stuff is satisfied, that the seller gets a basis step up to fair market value on the date of sale of the investment in the fund. There is currently no rule providing a basis step up for the inside basis. So in order to take advantage of the rule under the current guidance, the taxpayer must sell the interest in the fund. This has created some problems in the market because normally when fund investors get cashed out, they're not selling their LP interest in a fund. Oftentimes that interest is locked up. What happens is the fund pools capital from investors and then deploys that and buys a bunch of portfolio companies and redevelops those portfolio companies and then sells them off one at a time to the highest bidder, distributing the capital gains up through the fund to the investor. That's the common structure, but that would not work to take advantage of the Opportunity Zone benefits. So when we get into the sort of fund structuring piece, we're going to talk about some of the different structures that fund managers have come up with to sort of harmonize the business practice of selling off assets individually with the requirement under this regime that it is the interest in the fund that must be sold in order to get the key tax benefit.
So we'll go through one quick example of the tax benefits. In our example, we own Apple stock with a value of $10 million, a basis of $4 million, and we have a long-term holding period. If you were to sell this stock in 2019 and pay the tax, you would have gain of $6 million, $10 million minus $4 million, and you'd have federal income tax or capital gains tax of $1.2 million, so $6 million times 20%. You'd also pay the 3.8% net investment income tax. By contrast, and I will not go through all of the examples that are on this slide, you could end up not having to pay up to 15% of that tax of the 1.2 million of tax, and you could also avoid any tax on your future appreciation. So in this slide, we basically just show in the very first column what happens if you just roll over. What is the benefit of just rolling over and excluding gain? You don't get the 10%, you don't get the 15%, and you don't get the 10-year gain exclusion. All the way on the right, you have all of the benefits. You've managed to hold your investment for 7 years before 2026. You've held it for 10 years at least. So you get the 15% basis adjustment. You get the future gain exclusion. And you can see it basically cuts your tax in half. We go from $2.2 million to $1,020,000. So a lot of times these type of deals are getting compared with Section 1031 exchanges. If you're not familiar, a Section 1031 exchange is where you exchange property of like kind and you don't have to pay any tax on the exchange of these two pieces of property, assuming that you don't receive any cash in connection with the exchange. But there are some differences. In the 1031 exchange, obviously, we're rolling over real property. We're exchanging property of a like kind for property of other like kind. In the qualified opportunity zone, you're rolling over your capital gain, which at that point has likely been reduced to cash. The required reinvestment for a 1031 is going to be the entire property to the extent that you're getting cashed out. If you have a property worth $10 million and you get a $9 million property and $1 million of cash, you're going to have $1 million of tax. Here, you just have to roll over the amount of the gain. So our simple example of the $100 that we put in for a share of stock and we sold for $110, we had $10 of gain. You only have to roll over the 10. If it was a real piece of real property, you would need to roll over the whole 110. The reinvestment limits for a 1031, only real estate, but it doesn't matter where it is. Obviously, for opportunity zone property, it needs to be a qualified opportunity zone fund. The timing for 1031 is similar. It's 180 days, just like it is for qualified opportunity zones, but 1031 exchanges have certain identification requirements that you have to meet within a shorter period of time. The big benefit for a 1031 exchange is that there is indefinite deferral as opposed to a qualified opportunity zone where there's deferral until 2026. And there also is this current sunset provision where you have to sell by 2047. So in a 1031 exchange, you could roll over and just, defer your gain forever. Is any deferred gain eligible for reduction? Obviously, in a 1031 exchange, no. When you ultimately exit the investment, you have to recognize all of your gain. For a qualified opportunity zone, if you manage to get that 7-year holding period before 2026, you could exclude up to 15%. And for a 1031, your future growth is not exempt from taxation. You don't have this, if I hold it long enough, all of the gain is free. As a qualified opportunity zone, obviously, that's the big benefit. So based on that, we're just going to go through some key issues that investors need to consider. The first thing is capital call timing. Because you have this need to have a sale and then roll over within 180 days, you have a fund that's ongoing, needs capital at various times, but you have investors that are holding assets. How do you manage to time their sale of the assets and their 180-day rollover period with the needs of your fund?
I add one point on this is so we foreshadowed the friction or the inconsistency on the exit between what the investor sort of needs and how the fund is typically structured. But you have a similar friction on entry, which is investor sells capital gain from some asset. Unlike 1031s, it could be any asset, doesn't have to be real estate, and has to deploy that cash into a fund within 180 days. Simply subscribing for an interest in a fund does not meet the test. The money, it's not simply a subscription for an interest, but you have to actually make your capital contribution. And so you have this sort of urgency from the investor standpoint to get your money into the fund, but then you have the fund sponsors either saying, we don't need your money right now. Typically, you subscribe for an interest and then capital calls will be made when projects are identified and the cash is needed. A fund sponsor doesn't want to take money early either because there's a pref that starts ticking as soon as it takes the money into its hands. It owes you, say, an 8% return on the money that it has sort of gotten from you for the investment. And as we'll talk about later, there are restrictions separate and apart from that economic concern of the sponsor. There's a legal concern, which is you can't sort of front load the fund with a bunch of cash early because you'll end up blowing some of the compliance tests to be a qualified opportunity zone fund. So again, there are I would say, fewer ways that people have found to bridge this gap. We'll talk about some of them, but you have this, again, friction point, which is, how do I get my capital into the fund quickly when the fund may or may not need it?
And I would also just jump in quickly because we've seen this. People really should also be cognizant of when that asset manager is actually going to deploy that capital into a qualified opportunity zone fund. So they may be taking dollars into an escrow account, and they may take a couple of days to actually put it into a fund vehicle. And it's when it actually goes into the fund vehicle that you've met that 180-day window. So if you have an investor who has really waited until the last minute, that timing can become really critical, because if they're at 180 days and they think it's just when their capital's been called, but then the asset manager doesn't put it into the QOF for another couple of days, you're now past your window.
Yeah, I agree. The 180-day period seems long, but the biggest thing I think we ran into at the end of last year is people who had gain to roll over and funds that weren't ready to take the money, because the fund has to be a fund on the day you roll over, and that means it has to meet certain requirements, and people want to invest, but there just aren't enough funds out there to take the money sometimes. Similarly, a timing issue, if you are an investor and a capital gain event is not imminent, what should you do? Should you trigger your gain now so you can participate in the Opportunity Zone Fund, or is it better for you to keep holding your asset and not trigger the gain anyway? So the immediate benefit, obviously, for an investor is that you get to defer the gain, but you can also defer gain on a capital asset by just holding the asset until you want to sell it. So what is better for you, just to hold the asset or to actually get into this program where maybe you could get some other benefits? Obviously, that's going to depend on the investor position and whether they're, looking at other benefits other than deferral, like the 10 or 15% exclusion, and if they're thinking about holding this for a long term. Obviously, there's a distinction between 1031 exchanges and Opportunity Zone Fund investments, which we just went over. So to some extent, a rollover under a 1031 might be more beneficial than actually investing in opportunity zones. Opportunity zone tax benefits are not guaranteed. At this stage, we've received, obviously there's the statute, there's proposed regulations, and there's some limited guidance from the IRS, but there are a lot of issues that are open. I think Mike brought up the biggest one, which is right now you have to sell your interest in a fund rather than an asset, and funds want to have investments in more than one asset. So that could be hugely problematic going down the line if we don't get further guidance on that. Change in economic circumstances. Obviously, when you think about all these benefits, they sound great, but what if your fund isn't successful, so you don't really benefit from any of these tax benefits? And the last one is sponsor error. There are a lot of hoops that you have to jump through. The ones we just went over on the investor side. On the actual fund side, there are a number of qualifications that you need to satisfy. What happens if the fund that you invest in does not satisfy those qualifications? So there's no guarantee that you're actually going to get all of these benefits. It's really contingent on holding periods, economic circumstances, and continued qualification with these complex requirements.
On the sort of change in economic circumstances, or this not certainty of getting the tax benefits, if you read the disclosures of some of these offering memoranda out there for new Opportunity Zone funds, they will say, one of the key risks is may not qualify. The advisor may determine it's more economically beneficial to sell the asset or sell before the 10-year hold. So there's a lot of discretion, notwithstanding the need to comply with these rules to get the benefit from an investor standpoint. The fund oftentimes retains the discretion to either comply or not comply with these rules, depending on what makes the most business sense. So you got to be real careful. If you're doing this just for the tax benefits, you really shouldn't, because there's no guarantee that you will get those tax benefits.
Yeah, and I think the last point on here, do risk-adjusted returns support the investment independent of tax considerations? That kind of just goes back to the idea that, we mentioned at the beginning, there are opportunity zones that are located in some surprising places. There are opportunity zones that are located in some obvious places. And to the extent, though, that there hasn't been a lot of historic investment in some of these distressed communities, it's a more riskier investment. And to the extent that the investment is not successful, the tax benefits go away. So is it worth the risk to take on a riskier investment to possibly take advantage of these tax benefits? And I'll say we were talking earlier, and I think where people, at least that I've seen, have had the most success are people who traditionally go into these types of communities and have development projects, and they're really just changing their marketing to say, here's an extra benefit that we can now offer you. So that's something to think about when you're thinking about investing.
Thanks, Liz and Mike. I'm going to now turn it over to Mihir. With that background of the legal framework, perhaps you can comment on the trends that you're seeing in wealth management today.
So thank you so much for the time, and thank you, Venable, for including myself and Morgan Stanley in today's panel discussion. As trends in terms of what we're seeing from a client perspective, and that's really where I sit on this panel, is of what I'm seeing from clients coming to Morgan Stanley looking for not only opportunity zones, but what's happening within the wealth planning and financial advisory industry. We're seeing comprehensive and holistic styled financial advisory. So a lot of our clients are coming to us and they're asking for not just investment advice, but also looking for our certified financial planners, our estate planners, and tax planners to participate in the discussion. So, what has changed over the X amount of years, probably in the last 10 to 15 years, is this tax-driven investment advisory has really come to the core of making not only investment decisions, but core principles around building portfolios. So in pertinent to today's panel discussion, opportunity zones have become a big part of a conversation that has evolved over the years in terms of tax mitigation strategies and tax planning strategies for putting money to work, for not only for individual investors, but for smaller institutions, et cetera. So what we're seeing trend-wise is not only having this comprehensive planning offering to a lot of our individual customers, but specifically looking at investments that are going to help their tax situation over long periods of time. So I'm going to let the others get into the benefits and kind of perils of what's going on in the opportunity zone space. But, for the topic of opportunity zones, where we're seeing a lot of kicking the tires on customers, and customers that we're seeing coming to us, obviously large portfolio gains. It's been a long time. It's been 10 years since the financial crisis, been a long run higher in the equity markets. So people are sitting on some pretty large gains, not only especially in their portfolios, but in personal investments that have made over time, real estate, fund managers, et cetera, that they can use this particular opportunity to get a little bit of tax deferral. So that tax benefit of the opportunity zone is where everyone's kicking the tires. Where we're seeing a lot of concern is what happens for use of funds over the next 10 years. And as Liz just mentioned, what if the IRRs don't kind of match up with what you have been earning over X amount of years? So the concerns are pretty obvious, but again, you're starting with a little bit of a head start with not only the tax deferral, but also the step up in basis. So we're seeing from clients that they're interested, but they haven't really gotten to, the committal process or committal stage of where they want to be yet. And I think Erin's going to go into a little bit why. I think we're still in the early stages of where we are on the investment side of things, or investment cycle of things. And that's where Morgan Stanley is kind of representing a few of the fund managers that Erin will bring up. But that's what you're seeing from a client perspective. I know it's a little short and sweet, but that's at least what we're seeing in terms of the opportunities in Morgan Stanley's world.
Erin, do you have anything to add to that?
Yeah, I would say that, I think that when we first started looking at this back in the spring, sort of once state said these are the actual opportunity zones that we've designated, there was a lot of people that were reaching out to us saying, we want to do something here. We're really excited about the tax benefits. And that was really all that they were thinking about initially, were the tax benefits. And then I think that over time, investors have started thinking through, well, what will it do to my portfolio construction if I'm selling equities to go into real estate? That really does shift around what your portfolio is doing. So I think as time has gone by, as Mihir was saying, investors have become more measured in how they are looking at this. And where I think initially a lot of people were looking to put dollars to work as soon as possible to get the full range of tax incentives, I think they've now realized, okay, I may have to give up maybe that total 15% step up in basis by not having everything invested by the end of 2019, but I still will get a lot of the benefits if I'm doing investments in 2020, 2021. And it makes sense to evaluate any of these offerings from an investment thesis first, and then overlay that with the tax benefits.
I have a question for the Morgan Stanley folks, because the diversification, or sort of the overweight in one area versus the underweight, could that actually be a benefit, for example, where unlike a 1031, where you had to go from real estate to real estate, are people talking about actually using this as a diversification mechanism? I'm now overweight in my stock portfolio because of the run that the market has had, and I want to take some of those chips off the table and put them into maybe a private, not publicly traded asset of a diversified real estate pool. Is that, first it was the tax benefits really drawing everyone's attention, but has that diversification opportunity been much of a discussion point amongst your client base?
It has for us. I mean, I think the tax benefit of being able to defer the long-term cap gains out for X amount of years has provided an opportunity for us to present an idea that doesn't cost the client money on day one, minute one. In terms of it being an overly a diversifier, yes and no, because a lot of the clients that are in that position are more than likely already long a considerable amount of real estate. Erin can probably speak to a little bit about more of what she's seeing in the product side of things, how it's a diversifier. But for us, we're on the wealth management side of things, we're looking at it from a client perspective of here's an opportunity to defer taxes. And if it's pertinent in terms of it being a diversifier, great. If not, it's really more leaning towards a tax advantage right now.
And what I would say, so, when we are evaluating product, we're kind of looking for what is going to work for our broad range of clients. So the $5 million client up to the institution, up to the ultra high net worth individual. So we are a little bit more conservative in what we're willing to offer to clients. So especially within this space and within real estate, we're not comfortable doing single asset deals, and we're not comfortable doing co-investments. So when we've been looking at this space, we really have been looking to see where we can find asset managers who are going to have multi-asset deals that we can offer to our clients, because the other alternatives just don't work for us. That being said, within the Opportunity Zone structure and within the program, they have made it a little bit tough to do multi-asset type offerings, and I think asset managers have had to be really thoughtful about how they're structuring these deals to comply with the rules of the program. And I know we'll be talking a little bit more about structures and things like that going forward, but it certainly has been a bit challenging finding the right structure to do a multi-asset type deal.
Well, maybe that's a good segue, Walter, to talk to us a little bit about Opportunity Zone funds.
So on the topic of what is a fund and what structure funds are going to take on, let me, the risk of confusing myself, jump to the end and then come back to how we get to the end and tell you what it looks like in my experience so far. I think my team at Venable, what it looks like the structure for funds is going to be is likely you've got your investor who's going to take money, capital gain, and contribute it as equity. Got to be an equity contribution, can't be debt, can't be some other form of funding, got to be an equity contribution into the fund. And I'll come back in just a minute as to what the fund is. It's actually one of the simpler concepts we've gotten from the IRS in recent times at its base level. But then once you move beyond the fund and what it's got to do with the cash it now has, it gets complicated fast and will dictate what the structure is. So investor puts money into the fund. The structure we're likely to see is that the fund pretty promptly, because of timing and penalty rules, takes the money and does not directly invest it itself, but contributes it on to a tier of entity or entities or a single entity below it as a capital contribution, not debt. And it is that entity at the second tier down that actually runs the business, does the real estate development project, is actually where things happen. Let's go back then to what and again, got to be an equity contribution in there. We'll get into side topics of, well, can you get any additional money coming into the fund as equity? Yes. Can you get in as a loan? Yes. Can you bring money in down below as equity? Yes. Can you bring it in as debt? Yes. But none of that is under the fund program. The only money that's getting the benefits that we've talked about through the first part of this is equity contributions coming into the fund up top. So how do we get to this structure? Well, it begins with the fund. And so what the IRS has told us about funds is they have to be either a corporation or a partnership under tax law. So for the most part, particularly in the real estate world, nobody talks about corporations. It can be an S corporation, so maybe you go that route, but virtually all the talk so far has been as a tax law partnership. So what does that mean? That means under state law, you've got something that's perhaps a limited liability company, perhaps a limited partnership. The key structuring fact is for tax law to have a partnership, you got to have at least 2 members. So when you're doing a very narrow silo type deal with just a developer trying to just bring in money for its project, it can't use a single member limited liability company, this fund. It's got to have a typical joint venture, somebody else in there just to have a partnership. It's got to have a purpose stated in its organic documents that it's going to be a fund and what it plans to do with its money. But then comes one of the single biggest drivers of the whole discussion is this 90% test. That the fund has to deploy at least 90% of the cash it's gotten from its investor into one of 2 broad categories of things. And the problem is really, and I won't get too buried in the timing details of this, but that if it doesn't do that pretty promptly, at pretty much 6 months intervals, it begins to get hit with a penalty that's roughly in the 5 to 6% range if it has not deployed its capital timely enough into one of 2 things. And the 2 things it then has to do with its capital to meet this 90% test. Think of the 90% test is you got $100 of cash from your equity investor. At the 6-month mark after it goes in, and at the end of the tax year, at least 90% of that $100 has got to be deployed in one of 2 broad things. Either it's got to be spent on the business, running an actual business, which may mean it's actually spent it to buy and rehabilitate the building, or, and this is what dictates the second tier, it satisfies the 90% test merely by taking its $100 and taking at least $90 of that and dropping it into a second tier entity, a partnership or corporation, which will itself become a qualified opportunity zone business. So that is really what's one of several drivers. I'll hit the other driver in just a second, but that's one of the 2 big drivers that says we'll get to this 2-tier structure. I'll jump to the other driver just to make sure we get to these points. The other driver is a lot of tests we've got that I'll get to in just a second on what the business has to actually do. And again, the fund can choose to be a business, but it's running against the 90% test. And right now, there's no time frame, no safe harbor for the fund itself to hang on to some of that cash for a while. And for no particularly good reason, the IRS has given us a safe harbor down at the second tier level. So a fund takes its $100, drops at least 90 of it into a partnership down below. It's got under a safe harbor the IRS has given us at this point 31 months to deploy that before it hits a test that we'll get to in just a minute down at the second tier level. So those are probably, in my mind, the 2 big drivers, the 90% test versus different tests down below, and this safe harbor that you get down below. Now, the caveat that runs through anything we say this morning about tax law, other than some very basic principles, is it may change. The statute says a variety of things that's going to be hard for the IRS to get around, but then the IRS has given us one preliminary level of guidance with a whole batch of initial rules, for the most part very favorable, but we're going to get a whole other set of rules in different tranches along the coming months, which everybody's very hopeful are going to be in the favorable vein, but are going to give us more guidance. And it's hoped that there will be a safe harbor rule added up top, so that there's a time frame that the fund itself may have to deploy its capital, and it's not pushed into this structure where it's got to be right away thinking, gee, we've got our $100 cash, we got to do something with it, or we're going to get at year end start getting hit with a 5 or 6% penalty for failure to have deployed at least 90% of it.
Can I add
sure.
one point here? So we mentioned before about the economic issues with trying to preload a fund with cash, saying I need to get this cash off my hands within 180 days. Can you just take it early? There's the economic consideration of causing the pref to run, but also when I said there's a legal issue with that, this is where the legal issue comes from. In order for a qualified opportunity zone fund to be bona fide and meet the compliance test, 90% of its assets must be, consist of these 3 things and only these 3 things. Stock in an underlying qualifying business, a partnership interest in an underlying qualifying business. We'll get into that. or business property. Business property is tangible property used in the business, equipment, real estate, and so cash is neither of these things, none of these things. And so that's why, you have this friction point of needing to get rid of the cash, but the fund not able to just take a bunch of cash because it's going to cause it to fail this test. The test gets a little looser if the fund were to take it and then quickly get rid of it, sort of like hot potato, and say, okay, well, I can't hold it. I'm going to fail this 90% test, but let me push it down into one of the lower tier entities. There's more flexibility for the lower tier entities to hold cash early than it is for the fund itself to hold cash early. That's why what you're going to see is most of these funds use the two-tier structure because of that additional flexibility of, Walter's going to get into it, but working capital safe harbors, 31 months to deploy the cash if there's a plan to use it. All of those sort of looser, more flexible rules right now only exist at that lower tier level. They don't exist at the fund level. So that's why we typically advise on taking advantage of the two-tier structure versus the single-tier structure.
And I would also say that the 90% asset test is also driving whether asset managers, when they're calculating their management fees, are calculating it with inside the commitment amount, inside the investor's commitment amount, or outside of it. And a lot of them are coming down on the side is that they're going to do their management fees outside of your commitment amount because they're concerned that any management fees that they take in would run up against that 90% test or would be part of that 90% calculation.
In an unfavorable manner.
In an unfavorable manner, correct.
So we've gotten to the point in the structure where we've talked about investor putting money into the fund dropping it down to a second tier, and at the end of the day, whether it's the fund itself or a tier below, a limited liability company perhaps, owned by the fund, what you're looking to at the end of the day have is a qualified opportunity zone business. And there are 5 tests for what a business is, which the fund managers have to be looking to comply with. And I think of these 5 tests as what I'm calling in my own acronym, the SINS test, the SIINS tests. And the first one's the big driver that's a favorable factor down at this level. We talked about a 90% test up top. Another reason to drop the funds down is the substantially all test. And let me sidetrack here, and that substantially all is a common phraseology of tax law. Substantial portions, substantially all, something the word substantial in it pops up a lot. And it pops up a lot in these opportunity zone rules all over the place. The one place the IRS has told us what it means is for this particular, my S, the substantially all test, is 70% is what the IRS has told us. So merely by dropping down to the second tier, you go from a fund manager having to apply with a 90% test to generally just a 70% test. And it's a 70% test that if the fund, in fact, owns tangible personal property, which for most of what we're talking about today is the focus, buildings, real property projects, at least 70% of the business's assets, tangible assets, have to be deployed in the zone. So it's assuming that you've actually spent the cash to create tangible property and that 70% is in the zone. And again, the big trick there is you go from a 90% test to a 70% test just by reason of the fund having moved money from itself to another entity. Second test is an income test, the gross income test, that to the extent the fund has gross income, which it should at some point to be a business, at least 50% of the income has to be generated in the opportunity zone. Again, the theme you're going to come back here is tests that are intended to make sure that whatever is going on happens in the opportunity zone and you don't have mega corporation doing a trivial amount of activity in the zone with most of their real benefit being accrued outside the zone. So the theme of these tests is assurance to the compliance side of it that the benefits are being reaped from the funds being deployed in the low-income community. So we've got the substantially all 70% test, the 50% of gross income test realized from inside the zone, and then the intangible test. Again, this is an if test. If, in fact, the business is going to have intangibles, a substantial portion of those intangibles have to be in the zone. Move on to the next test, my N test, which is non-qualified financial property. And this is another test that drives a lot of the discussion here. It's a test that carries over from other areas of empowerment zones and the new market tax credit world, that it's intended not to have businesses that are largely in the business of being a financial institution. It really says you can't just hold cash, you can't just hold debt, you can't just hold equity interests. If more than 5% of your assets are in those type assets, you're disqualified. And that's really a driver that pushes the structure the other way. If you go down my chain, investor puts money into fund drops money into second tier. This rule is really saying that second tier entity can't really take its money and drop it into a lower tier respected entity, because it's going to then have what it actually owns is going to be equity or debt interests. And to the extent those exceed 5%, this test is going to be negatively impacted, and you're going to fail it and not have a qualified its own business. So put a different slant on that is saying that the business in the zone can't be a fund itself. It can't be a manager of assets. It's intended to spur active type trades or business in the zone that employ people and not just hold interests in other entities. So, and the last test on my list of 5 is the true sins test. The S there is really standing for sins, in that there has historically been a group of disfavored businesses, and they include typically things like country clubs and massage parlors and alcoholic beverage companies that you simply can't use funds to invest in. It doesn't come up very often. It occasionally comes up in some very limited context of, well, the hotel wants to have a health club spa or something. Does that trigger the sins test, the last of the 5? So
I would say, just to sort of sum up this slide, this is basically what the lower tier entity would need to satisfy in order to qualify as a qualified opportunity zone business. So you go back to the 90% test. 90% of the assets of the fund need to be either stock in a corporation that's a qualified opportunity zone business, a partnership interest in a partnership that's a qualified opportunity zone business, or run the business directly. For the reasons we talked about, typically don't advise it runs the business directly, so it's then going to default into the stock or the partnership test, meaning that those lower tier entities need to satisfy all of this stuff in order to have a good qualified opportunity zone fund.
Come back to one of the drivers of structure at this point, again, is this safe harbor that the IRS has given us, a 31-month safe harbor that's available not at the fund level. If I were to guess, I would guess the IRS will ultimately give us a safe harbor up there for more time to actually deploy the cash before we hit these 6-month testing rules and penalties that kick in at the fund level, that we may get some favorable timing rule. At the moment, we don't have it. So all the focus is on, at the second tier level, we do have a 31-month safe harbor. If the fund does 3 pretty basic acts, it puts a written plan in place, it has a schedule when it plans to spend its cash, and then it has to actually use the cash in accordance with its plan and meet the 31 months spending down. And that 31 months sort of comes off, I think, the perspective of doing a real estate project, that if you put the fund into the money into the fund, drop it down to the second tier, that 31 months is a reasonable time to take that $100 of investor cash or $90, whatever you've actually dropped down, and be able to spend it on the real estate project. As with a lot of things we don't know, several of these spending rules have reasonable exceptions, type safe exemptions to them, but we don't know what that means at that point. We may get more guidance on that, some sort of did you act reasonably in trying to comply with them, and perhaps we'll get guidance that gives some more leniency. But right now, they're sort of taking the worst case view on some of that.
And I would say that it was this was clarified in the guidance that came out in October, the safe harbor capital deployment. And that, I think, at that point, that's when a lot of asset managers decided that they actually could really start moving forward with something. Prior to that, they just weren't sure how they would actually take in cash and deploy it in the way you normally would with private real estate investing and make it work. So it was really that clarification that came out in October that made a lot of asset managers feel like they could at least start forming their funds and moving forward.
Let's see, considerations to determine fund structure. This is kind of a rehash of just where we've been, that Investors got to have capital gains. It's only the capital gains that have to go in. Let me sidetrack there to a point I just hit on real quickly earlier, which comes up very commonly is, so, in the very simplest of models, you would simply have investor just take their $100 of actual gain that they're trying to avoid being taxed on, drop it in, and then the fund would use that, probably dropping $90 to $100 of that gain into its second-tier entity to actually use. Can you get other funds in there? Can you get other assets in there? The general is yes, you can do all those things in terms of getting other funding in there. None of that other funding is generally going to qualify for the benefits of the program, with maybe one exception, I think, that I'll hit on real quickly. So that is to say, at the fund level, can the fund bring in totally uninterested parties? Yes. It can borrow money from a bank. It can borrow money from friends. It can have people who have no interest in the program whatsoever put money in just because they think the project's good and don't intend to get the Opportunity Zone Fund program benefits. Drop down the second tier, and you get the same comment there. The second tier, the only money that's going to get the benefit out of it is the actual capital funding that's come down. And so what I repeatedly use is you can get silo effects, and this is, it's a good employment act for the tax attorneys among us. It's a full employment act for the accountants among us, because when you get particularly these funds are going to get complicated fast, they're going to have money that comes from the investor who's rolling their capital gains in, which is going to have a sort of a silo to it that's going to have to be channeled and monitored because it's the only one that's going to get the benefits out of this program. But along the way, you're going to have other funds coming in that don't get the benefit of that. And where I was just headed to is down at the actual business level, the lower tier entity. It can also borrow funds. It can also get money coming in from other parties. And another typical quick sidebar that we could spend a long time on is just, you may have your manager in the project, just like in a typical real estate deal, that's want a profits interest or carried interest. And yes, they can come in potentially at these different tiers and have their kind of weird waterfall of profits interest or whatnot that enables them to get a different slice of the pie than maybe going to the nice, neat fund investor. And that's where folks like me here and Aaron become particularly valuable at trying to figure out who's getting what out of the pie at the end of the day, just like any other investment.
I'd add one thing on this point. So it says investors must invest capital gains. It's to get the tax benefits, it has to be a rollover of capital gains. But as an investor, you could you can invest both new money and capital gains. There's not a restriction on just investing regular dollars versus rollover dollars. So, what you might commonly see is that one investor having sort of like a mixed investment in a fund. It has $50 of capital gains, but it wants to make a $100 investment. It can do that. It writes a check for $100, but only one half of its investment is going to get these tax benefits. You're not restricted on participating in a qualified opportunity zone fund if you don't have capital gains.
Coming back to a point you mentioned earlier, Mike, is this one that's the second bullet here. That the exit must be at the fund level. And again, this is a major fumbling point in the whole discussion that really the structure doesn't work well at all. And that's just because it comes out of the statute that everything is contemplated as working at the fund level. And it comes from a core rule that's in the statute that the Congress has given us, which is that when you roll your $100 of gain in, your basis in the entity is zero with respect to that. And that's how you kind of get the benefit of and get stuck with that gain not being captured yet, is because you've got an asset worth $100 in the form of cash at the moment that you've dropped in, but a zero basis in the fund. And everything is premised on that when you 10 years or more out try to get out of this, you're selling out of the fund. And in the first instance, that may not sound awful, but when you get into this type of structure where perhaps you have a fund which has diversified itself across multiple projects down below, and in perhaps the worst case, maybe it's got 10 projects, and in year 5 it decides one of those projects really isn't one it should stay in. We really don't have a good answer now. If the fund chooses to get out of a project early on, what happens? What happens if it has cash? Can it redeploy that cash? I think everybody's hoping we'll get a solid, favorable answer from the IRS that you can sort of roll within the fund. We don't really have that guidance yet. And we also have the idea that, in corollary with that, you can't really sell out down at the lower level that the investor up top's only means of exiting and getting the benefit of the gain deferral and exclusion is by the selling out of its fund interest. So again, a structuring challenge that really remains with us at this point.
So kind of the structuring challenge, this is where, for us lawyers, was it slide 30? Let's go to slide 30, where it gets interesting, which is you have a portfolio manager, a fund sponsor that doesn't want to do a single deal, wants to do a lot of different deals, but it also wants to get the tax benefits to its investors is one of the key draws to investing in the fund. So how does it do that? I mean, how can it set up a structure that allows the investor to exit at the fund level and still do projects on an individual basis? And so here are a few things that we've seen in this regard. One concept, what I've heard about in theory, I have not seen a fund actually do this, but presumably you can have a series LLC. It's a single LLC that has different sort of subgroups within it. Each subgroup or series is treated as a separate tax partnership. So each series would make the Qualified Opportunity Zone Fund election. So what Walter was saying is, from a tax perspective, you need to have a separate tax partnership for each fund. Well then, okay, you could form a single state law LLC, but then within that have a different series for each project. From a tax perspective, that would be good because you have a different partnership for each project, and then when the sponsor wants to sell one of the projects, it could sell the series, the interest in the series, which is treated as an interest in the fund from a tax law perspective, and then you would be good from a compliance standpoint. That is not particularly different from the alternative investment vehicle structure, and I think which is what we have seen, or I have seen, which is, okay, well, I'll just, suck it up and form a different LLC for each project. And instead of the typical structure of investors contributing to a single fund vehicle, I'll just say in the fund documents that, okay, each project is going to be created in a different LLC or alternative investment vehicle, and investor, you're responsible for funding that vehicle when capital is called for that particular project, and that way the fund sponsor can sell each partnership separately and have a good exit. So the series LLC and the alternative investment vehicle concepts are really the same from a tax law standpoint. I think because of the clarity of just using, or the cleanness of using separate LLCs for each project, that's probably more common. Series LLCs, I think they're a little less developed, so I haven't seen, they carry their own issues, so the AIV concept is probably more common. Another approach for these big funds is to use a REIT. The exit strategy on a REIT could be either an IPO, and then when the REIT IPOs, then the REIT shareholders can sell their interests in the public market, thus giving them liquidity at the fund level. That's one approach. Also, one strategy that we've seen is for the REIT to adopt a plan of liquidation, which would allow the REIT to sell all of its assets pursuant to a plan over a 2-year period, the plan of liquidation. And what that is treated from the tax law perspective is a sale or exchange of the interest in the fund itself from the investor standpoint. You wouldn't have entity level gain under the particular REIT rules, and you would get sale or exchange treatment from the investor perspective is what you need in order to comply with these opportunity zone rules. So those are sort of 3 approaches to threading the needle of doing a multi-asset fund while still complying with the exit at the fund level for the investor.
And one thing I would say is that for investors, especially if it's a Series LLC or an AIV, they're going to be getting a single K1 for each one of those properties. So unlike a commingled fund structure where you get one K1, investors are going to have to be aware that they will get multiple K1s.
I can't help but adding on to that wonderful discussion the comment that with all the complexity and risk involved in the existing opportunity zone structures, those avenues just add on another level of risk and uncertainty because there are a lot of questions in the tax law side that aren't answered but that you're driven to as to how do you unwind one of these things in a world where it's very awkward to know how to get out. So it's providing, with some labels of uncertainty at this point, other avenues to how you may get out, but again, taking on some risks and unknowns along the way. Just a few big points before we wrap up. How are we doing time-wise?
Yep, we have a couple more minutes.
All right, just back to a couple big pictures and back to the 70% test. So the two big things you can end up with at the end of the day conceptually are some sort of project, a real estate-oriented project, which is where all the focus has really been that I've been largely dealt with. There's no reason this program is really intended to accommodate, a startup-type business. The rules really don't favor that at the moment, but I think it's pretty certain the IRS is going to be forced to go to make rules that work better, to not be funding just the project, the building bricks and mortar, but to be funding somebody who just has computers and tables and leased office space and is going to do wonderful things over the next year to take a zero-value couple people sitting in a room and turn it into a big technology business. This program is very much intended to enable that, but the model really and the focus hasn't gone down that route yet. So focusing on the real estate project type model where the emphasis has been, one piece of that is back to the 70% test and the idea that you've got a numerator where you've got to have at least 70% of your tangible assets in the zone and everything else you own gets in the denominator. The only way you get stuff in the numerator is if you either acquire it by purchase from an unrelated party or you actually spend the money to improve property in some fashion. The first piece has driven a lot of discussion of you've got to acquire by purchase from an unrelated party to get into the numerator of that test. And that's what has come up with where my developer already owns the property in the zone. He's all set to go do something. What do we do? Because that property, by definition, has not been acquired by purchase by the fund or by the business that the fund owns. The related party test says that the developer can't be related to the fund by more than 20%. We've got a 20% label, so that if the developer were to sell its land in the zone to the fund and want it to be a good asset in the fund, the developer's interest in the fund's got to be at or below 20%. It can't kind of stay in. And we've just done a deal where the developer is comfortable with that. It took a real focus on what it means to have a 20% interest in a partnership. Tax law gets a little screwy at times on just what it means to have a nice interest in a partnership. It's clear that, if the developer's putting in, if the other parties are putting in $80, the developer can't put in any more $20, so that their capital accounts are at or below 20%. It gets more challenging to get comfort of just what the profits interests are over time, but somehow you get there at this point.
Yeah, I mean, if it's a straight pro rata deal, I've put in 20% or no more than 20% of the capital, and I only have 20% of the profits, then it's easy. You've complied with the test, but oftentimes deals are more complicated than that. There's a preferred return. There are different profit tiers and profit splits and all that stuff. So oftentimes profits don't flow in accordance with capital contributions. It's one of the benefits or flexibilities of using an LLC structure, and then it gets a little tricky to apply black and white rules like this to very sophisticated or complicated business deals, and that's another thing which is not clear in the guidance right now. So.
Yeah, and where the mind quickly goes is, okay, we've got this 20% test, we got the land we want to get in there. How do we get in there? The only way it's a good asset is we purchase it. Can we get in there otherwise? And the question becomes, well, what happens if the developer contributes it in? Can they take back an interest for that? Well, if they contribute it in, right away it ends up not in the numerator where we want it to be of the 70% test, but in the denominator. So it's counting against us to the extent we put a value on it, whatever contribution amount the developer wants on that money when it goes in, that land when it contributes the land in. If it wants a capital credit of it for $10, that $10 is going into our denominator, but not helping us in the numerator because it was a contribution, not a purchase. Leasing is the other option. Can you just do a ground lease? Well, yeah, you can. The truth is we just don't really know what's going to happen with leases yet. The rules the statute says you can lease it, but then doesn't tell you how you quantify a lease. And I don't know how you quantify a lease. I mean, a lease isn't an asset really. It's more like a liability. So the rules the IRS in the statute have given us, I say Congress has given us, sort of treat a lease as though it's an asset, but nobody really thinks of it being an asset. So if you lease it, it's not really clear how it fits into this fraction that's contemplating you own an asset. So leasing is a topic we're going to hear a lot more on, and maybe an avenue that gives us a way to get property owned by a developer in that doesn't taint us. But
And not only to get property in, but also maybe get a little more of the profits to the existing landowner. So, you know, if you do a sale to an affiliate that doesn't technically trip the affiliate rule, at most that person can participate 20% of the qualified opportunity zone fund. But what if the value of what he or she is contributing is worth more than 20%? How can you structure it to sort of make the economics fit with the legal requirements? If you can't do contributions, well, maybe you do a ground lease with some participation. And, you know, it's not uncommon to see third-party contacts to ground lease with some percentage interest in the gross proceeds of the venture that's, you know, operating the business itself. So maybe you could structure something where, okay, some of the profits come out in the form of participation in the gross proceeds there. You know, it gets complicated and tricky, but that is, you know, at least conceptually one thing you could do to get a little more participation to the current landowner.
I think we should.
I was going to say,
Yeah.
I very much want to hear what Erin has to say, so I definitely want to stop there and we can deal with questions later. So.
Great. Okay, so Erin, despite all of this complexity, there are funds on the market. So maybe you could talk to us a little bit about how you assess and differentiate the products that are on the market today.
Sure. So we spent a lot of time developing matrix the metrics for how we were going to evaluate these properties, or evaluate these offerings. So we looked at it both from an investment thesis as well as an offering thesis, and then we, as asset managers would come to us, we would score them on different metrics that we had put under those two buckets, and then at the end of that, we'd give the asset manager a score, and that would sort of help drive who we were going to work with first and who we were looking to put in our pipeline. So when we were looking at opportunities from an investment standpoint, the first thing we were looking at was the capabilities of the real estate manager. So, and I think we alluded to this a little bit earlier on, most of the opportunities we have seen within the Opportunity Zone program are going to be in real estate. We know that there are abilities, or that there is opportunity to do private equity type investing, but I think a lot of asset managers have stayed away from that, at least initially. So everything we really have been looking at has been in real estate. So the first thing we looked at is the real estate manager. Are they an established real estate manager? Do they have a track record? Where in real estate have they played? Because of some of the tests that are required under the program, most of the real estate investing that's going to be done is going to be development real estate investing. So is this an asset manager that's used to just doing core? Are they ones that do value add? We really had to evaluate the capabilities and where within real estate these asset managers do typically play. Then the next criterion for evaluating them was, do they have development experience? Do they typically do development in-house, or do they work with development partners outside? I think once additional guidance came out in October, where they made it clear that it was the value of the land was excluded from the substantial improvement test, that did actually open up the world of asset managers we could work with a bit more, in that instead of just doing straight development, you could have some really heavy redevelopment. So some of the value add managers were maybe more, we were able to look at them a little bit more closely than we were before. So we were evaluating them on their development capabilities or the partners that they would be working with. The next area that we were looking at was their portfolio construction. As I said earlier, just because of the way we do business and our client base, we really had to focus on doing multi-asset deals. So from a portfolio construction standpoint, we have to look at how many assets does the asset manager actually think they're going to be putting in this portfolio? How concentrated can that portfolio be before we're just not comfortable doing that? Additionally, we do have to look at whether they're going to be concentrated from a geography standpoint as well as from a sector standpoint. I think what we're seeing is a lot of asset managers are tending towards doing multifamily. And I think most of them are kind of coming in the neighborhood of 75% of their portfolio will likely be in multifamily. We're seeing a little bit of industrial, some people that are going to be doing hospitality-type plays, and a little bit of retail, but more sort of in the mixed-use category. But mostly it has really been a lot of multifamily that we're seeing out there. After that, we really did have to evaluate what their pipeline looks like, because I think as dollars start being put into the space, and I think initially people thought dollars were just going to rush in really fast, and the properties that were available out there in opportunity zones were going to be bid up very fast. So we had to be really cognizant of the pipeline and the sourcing capabilities of these asset managers, so that they did already have a pipeline that was a forward-looking pipeline that they could reasonably put into their portfolio and deploy dollars on a responsible basis. From there, we also did want to take a look at what their plan was when the fund actually wound up. Do they have flexibility in how they were going to be able to sell assets? Were the terms going to be investor friendly? So the deployment plan of the asset managers was something that we had to look at really closely. And on the investment side, the final piece we were evaluating them on was, are they doing any kind of impact investing? Because if you think about where this came from, it really was, the Opportunity Zone program was really meant to impact low-income communities. And I think, as people have mentioned, some of these opportunity zones are in areas that you would not necessarily think were going to be opportunity zones. There are places like Scottsdale, Arizona, downtown Los Angeles, things like that. So we had to look at whether or not the asset managers are really going to be taking a real impact approach to their funds. And I think what we're seeing is, where they can do impact investing, they are. But from what we're seeing, no one's really marketing their fund as an impact investing fund, because I think they were looking at the return profiles of what that would look like, and it just didn't actually look all that interesting. So there's maybe a portion that people are doing in the impact space, but most of these funds are not going to be marketing themselves as impact investing type fund offerings. So that was on the investment side, how we were evaluating them. And then we also just had to look at it from an offering standpoint. So what were the terms of the fund offering? I think that as we were looking at the space, I think initially some people were thinking, well, maybe we could charge higher management fees than normal because it's a really complicated product. And I think where we came down and what we've been pushing for with asset managers is that from a fee standpoint, it really should look like any other private real estate type investment from a fee standpoint. We do not, if they started charging additional fees just because it was an opportunity zone program type offering, it really would start eating away at the returns. So when we've been evaluating opportunities, they really do have to look very similar from a pricing standpoint as any other private real estate offering outside of opportunity zones.
Yeah, and one question in there.
Mm-hmm.
Do you have any number you tagged, sort of what the tax benefit out of this program is? I mean...
So we've heard different things from different asset managers. They tend to say, the targeted returns that we're hearing most from asset managers tend to be high single digits or low double digits on a net return basis. So somewhere in the 8 to maybe 11% net return is sort of what they're talking about. And I think that surprised investors a lot, because I think they were initially thinking that these were going to be development type returns. But what they were discounting was the fact that you initially have that development piece, but then there's a 10-year hold. So the returns are not going to look like development returns. And I think that has surprised investors a lot. But again, that 8 to 11 is before any of the tax benefits. And what asset managers have been projecting from a tax lift is somewhere in the neighborhood of 200 to 300 basis points of increased performance based on those tax benefits. From an offering standpoint, also from a term standpoint, again, I think that a lot of asset managers have to be really thoughtful about how long this fund is going to be in existence. Certainly we know that you could, in theory, hold your interest until 2047 and continue to defer, and you continue with the deferral of the tax exemption of the end gains. I think a lot of the investors I work with are not necessarily comfortable with an indefinite period. So most of our asset managers have been looking to do something in the neighborhood of either a 10 or a 12-year term, with either a 3 to 5 year extension. So they'll do 1-year extensions to essentially get to that 15-year period. That gives the asset manager a little bit more flexibility about when they actually will sell assets, depending on where we are in the cycle and how things are going. We also had to look pretty closely at fund size. So there are some asset managers that are out there thinking that they'll do somewhere in the $3 to $5 billion fundraise. I think we've typically been more comfortable looking at asset managers that are probably in the $500 million to about $1 billion, maybe $1.5 billion, from a fundraise target standpoint, simply because we think that in order for them to be able to responsibly deploy capital and take it in, that range is a little bit more manageable, just from what we're kind of seeing out there in the space. Again, I would also say that one of the things I think that surprised us the most is that investors have really struggled with that traditional capital call structure and how they will realize gains to meet a typical drawdown structure, especially if it's going to last over a 1 to 3 year period. I think what we've been hearing is a lot of investors are really preferring a single capital call structure just so that they have certainty as to when their proceeds will be, or when their realized gains will be invested. So we have had to work pretty closely with asset managers to understand, can they actually take in capital have they structured their fund, and do they have a sufficient pipeline to be able to deploy capital that's all going to be coming in at once? So that's been a big discussion point with us, with asset managers as we work with them. I would say the final thing that we were really looking at from an offering standpoint is, are these asset managers, the way they structure their funds and the way they intend on operating, is it based on current guidance of the regulations, or is it what they think guidance is going to come out down the line? So we've had to be pretty conservative, and we really are currently only willing to work with asset managers who are going to be structuring and complying with guidance as it is, not with how they expect it to potentially come out a little bit later on down the line.
Thank you. I think maybe at this point we'll see if the audience has any questions or comments.
Two basic questions on the tax side. You use the example of the Apple stock. In the example, you sell $10 million and you roll the whole $10 million into the USD. What if you only took the $6 million in gain, rolled it over? Is your basis zero, or is it pro rata to your original portion?
So if you roll the whole 10, If you roll the whole 10, you'll have the problem that Walter talked about earlier, and that you only have $6 million of gain to roll over, and your benefits are only going to accrue with respect to the $6 million. So you kind of would have a bifurcated investment. So you'd have $6 million that has a zero basis, and then $4 million that has a $4 million basis. If you just roll the 6, you'll just have a zero basis, because that's the maximum amount of your gain.
And then just second, unrelated, the tax exemption only applies not to the income realized.
That's correct. Yeah, so I guess that question, he asked what happens if your project is hopefully making money as it goes along, and to the extent that your project is generating ordinary income during this intervening 10-year period, that would get passed through to you on these K-1s, and you would have ordinary income. There's no tax benefit during the actual 10-year operations phase. It comes on the back end when you actually sell.
I think a lot of asset managers are trying to explore whether they can use debt to create some kind of basis, at least early on in these vehicles, so that they could potentially use depreciation to offset some of that. But again, they're still kind of working through whether that's allowed and whether or how they could actually do that.
And the IRS did very much, as you were indicating, Aaron, give us the suggested guidance that the fund could borrow and create basis somehow that's different than the zero basis and that is not detrimental in the fund process. But it quickly heads down an avenue where we have the existing partnership rules. Again, most of these are likely to be partnerships for tax purposes, which has a massively complex set of basis rules which do not align well with this statutory statement that the basis of the investor with respect to the zone investment, the capital gain rollover, is zero. Because you have as Liz just said, you've got the operations which are going to go on for the next 10 plus years, which are going to have ups and downs in basis. It's not clear how those rules align properly with this fundamental zero basis rule, but it will be worked out and we'll find out more. So.
Yes.
I have a question for Aaron. Are you seeing any funds that are not really looking at this from a real estate perspective, but more from a business investment, or almost more like a venture fund rather than a traditional real estate fund, looking at qualified businesses that are being started or moved?
We've seen substantially less of that. There have been very few asset managers that have come to us with that type of fund offering, and I think part of it is because I think they are still trying to work through some of the tests that would have to be applied to opportunity zone businesses to make it work. I suspect that we are going to start seeing more of those as guidance firms up and people understand how they actually would operate within that. But I almost think that's like second wave of opportunity zone offerings. Real estate has been the first wave, and then likely that sort of more private equity type investing would be the next wave.
And to elaborate on exactly where Aaron was, we've focused on this 31-month safe harbor we have out there that gives the lower tier entity 31 months to spend its funds without getting penalized. That rule, as currently drafted, only applies to project-type arrangements. It clearly has held in reserve whether that would work for an operating business, and comments have been provided saying you got to make that rule work for the operating startup business. But at present, you get stuck with a rule that says you need to be spending this money essentially right away for a startup business, which just doesn't work at all in that model. So, yes, more guidance to come.
Yes.
Have any of you heard of this being used for sports stadiums?
Well, I saw an article just a couple of weeks ago about how a lot of the sports stadiums are located in zones. I mean, it goes back to the topic in that regard of, for an existing stadium, you'd have to figure out this whole related party rule. It just doesn't work to deal with an already owned property. I think there's a disfavoring out there of using some of these incentive programs for sports stadiums, and that was the theme of this article. There's nothing in the rules that says you couldn't use it if you're trying to build the new minor league sports stadium in a small city opportunity zone or something. So,
if it's for the Mets, it might be a sin business. So.
Yes.
Can this program be combined with something like brownfield tax credits, brownfield program combined with program?
The brownfields is a state tax program, so I don't see why that could not be combined with a federal income tax program like Opportunity Zones. But what do the tax lawyers think?
I'm not aware right away of any preclusions you've got on sort of combining some of the benefits, other than that there's just so much complexity in these rules themselves that the focus has just been on how to make these rules work, let alone trying to get the other rules to harmonize with them at this point. I'm trying to think if I've actually seen like a new market tax credit program deal done. I don't think I have, because I haven't seen one of these real deals done yet. Yeah, actually, I'm sorry, we did. We did just do a program that was jointly funded with New Markets and this type deal with the New Markets with some of the non-qualifying funding. So, in that regard, yes.
Is there another question? Yes.
Question for private equity or venture type sponsors, because of this 10-year horizon, longer than a typical private equity investment. Are the 2 and 20 to promote carry math that you see different proposals for that to help the sponsors get sooner than 10 years? Or?
So I would say that what we've been seeing so far are pretty typical structures that you're seeing from an incentive fee standpoint, and like they aren't shifting it because of this 10-year hold. Yeah. Though we have seen some that are saying that they actually are only going to charge management fees during the investment period, which is sort of a different spin on that.
Any other questions?
So you mentioned there's penalties for failure to meet the tenant investment. I'm imagining this scenario where you have a number of portfolio companies, and if failure to deploy capital in a safe harbor puts you into a penalty period, is that assessed at the portfolio company level, or is it assessed at the fund level in terms of what the penalty is?
All these rules, those rules operate at the fund level. And
what I'm thinking is, with the span of portfolio companies, a small cost that puts the overall fund out of non-compliance would be a small sum, a project busted, contractor can't complete, and that was the plan for deployment of capital. It could have an outsized effect on the top and drive some very interesting business decisions to operate companies.
Yeah, and then the penalty is computed based on how much you fail the test. So it's not like, you know, a small technical error, or some, maybe a 1% off from the 90% test is like a REIT situation where you blow it, and then you have a penalty because you lose REIT status and now you're a C corp, and that has outsized implications. Here, the penalty is computed based on how much you have failed the 90% test, and the penalty, effectively the underpayment rate, is assessed on that delta.
I drill down a little more because it gets messy very quickly. We've talked about how the fund is the one that's got the 90% test. If it has dropped its money into a lower tier entity, by definition it has met the 90% test to the extent that entity is a good qualified operator owned business. There's no 90% test down here. It's really whether this thing is good or bad. And if this thing suddenly becomes bad, then you've just kind of failed the 90% test massively, because everything down here is bad. It's not kind of like there's a different test down here. If the 70% test is failed, the penalty doesn't go against that 70% test. It's just you failed down here, and the 90% is not invested in the qualified business. So down here we don't sort of have this softness of, you know, it's a 90% test you're running against. It's kind of an all or nothing. You're either a good business or bad business with these 5 different tests you're trying to satisfy. And if you have more than 5% of your assets in cash, well, you fail that one. It's not a good business. 90% of your assets aren't in a good business, and you start getting penalties. So it's a messy topic.
And that's what, at least on our side to date, our preferred structure has been a single AIV, each holding a single asset without any overarching fund structure, just because we are a bit concerned with the lack of flexibility and some of the ramifications if one deal was to blow up within an OZF structure. That's not to say that we won't shift if guidance makes things more flexible and opens up, but right now we're just trying to be as conservative and sort of right down the line as we possibly can be.
Yeah, that comment, you know, a lot of what I do is just the developer trying to do the project for themselves, which is very much the siloed deal, which is to me the thing that works best within these rules. As soon as you go into multiple investors coming into a fund and the fund doing multiple projects, it gets complicated quick and the risks go up incrementally or whatever.
Yep.
So how does it work from an investor perspective? I come in and say, I want to reinvest my $5 million gain, and you fund are looking at, 6 different projects, but it's all each separate entity. If I give you my $5 million gain, do I get to allocate which project? Do you allocate for me? And how do I have separate fund documents that I have to sign for each?
Yeah, so I think people are approaching it differently. Some are giving investors discretion as far as determining which project that they do want to allocate to. We don't typically give investors discretion that way. So we have been saying if you are coming in as an investor, and the way we've seen most documents structured, you are essentially doing a subscription document with the general partner. So you're not doing it with the fund, you're doing it with the general partner, and then the general partner is essentially saying, I'm going to give you a pro rata allocation to every deal I have, the ones that I currently have, as well as any future ones that would fall under this the general partner's purview. So it's one fund document, and then you would be allocated across each of the deals.
For future ones, they just move your capital from an existing.
Well,
Leave it out.
that gets into the importance of pipeline and whether they're doing a single capital call or multiple capital calls. Because if they're going to do a single capital call type structure, they really should know every single deal that's going to be in that portfolio so that they can allocate across all of them. Because there's a challenge with trying to rebalance, or our understanding is you really can't rebalance across the various QOS. So if you're doing a single capital call structure, the asset manager really should know every deal that's going to be in that portfolio. The other alternative would be if an asset manager is going to do multiple capital calls, either they close all investors before they call the first dollar, and then they just call capital from all of their investors that have closed from that point going forward. Or they could, in theory, have closes and capital calls and have investors coming in at a later date, but those investors coming in at a later date would not have exposure to those earlier deals, which is just not, we have not wanted to do something like that, but that is a possibility.
And one collateral comment that probably said along the way, but why this picture you're seeing really is what we're serious saying is the structure is the statute we've got contemplates the investor putting the money into the fund. It doesn't permit any entity in between. It doesn't contemplate or permit like a feeder fund where you put money into a fund that's not the fund that then invests into the opportunity fund. It's the investor with its gain is directly investing in the fund. And second negative is it does not contemplate or permit funds investing in other qualified funds. It's strictly your money goes into the fund, and the most the fund can do with it is invest in one tier down, not into another qualified opportunity fund.
Yeah. And to that point, you can't have more than two tiers, because if you were to treat those portfolio companies, say, no, we want to form holding companies and then have the operating companies underneath, that level of holding companies would disqualify the funds, because that would be those partnership interests or stock, whatever you however those holding companies are formed would be non-qualified financial property, and then you effectively blow your qualified opportunity zone status. So the most you can have is two tiers.
So as you can see, they've really made this easy for us to do. So well easy to structure.
Yeah.
Well, we could probably talk about this all day, but I think we're out of time. So I want to thank our panelists and thank all of you for coming today.